The moment you hear that silver is running out, your instinct is to roll your eyes. We've heard scarcity stories before. Oil was supposed to be gone by the year 2000. The dollar was supposed to collapse every election cycle. And yet life went on. But here's the uncomfortable question most people aren't asking. What if silver isn't becoming expensive because of speculation, but because it's quietly becoming unavailable? And what if the biggest shock to the silver market didn't come from Wall Street, but from Beijing? Welcome to Cash Historian. Right now, headlines keep arguing about inflation cooling, interest rates peaking, and soft landings. But beneath that noise, something far more structural is happening. Silver inventories are thinning. Industrial demand is accelerating. And China, the single most important player in global metal supply chains, just made a move that caught most Western analysts flat-footed. Prices are reacting, but prices are the last signal, not the first. The real story starts much earlier, long before silver charts began pointing toward numbers like $60 an ounce. To understand why this moment feels different, we have to rewind. Silver has always lived a double life. For thousands of years, it was money. Not symbolic money, real money. From Roman denarii to Spanish pieces of 8, silver lubricated empires. It financed wars, paid soldiers, and built trade routes that still define global commerce today. Even in North America, silver's role was foundational. The United States Constitution explicitly names silver as money. And for most of American history, paper currency was just a claim on metal stored somewhere else. That system began to fracture in the 20th century. The gold standard cracked under the weight of world wars, and silver was slowly pushed out of everyday monetary use. By the late 1960s, silver disappeared from U.S. coinage altogether. Canada followed a similar path. Officially, silver was demonetized. Unofficially, it was repurposed. Instead of money, silver became an industrial input. Photography, electronics, medical applications, chemical catalysts. Quietly, silver transitioned from a store of value into a consumable resource. That shift changed everything, because unlike gold, silver gets used up. Gold sits in vaults. Silver gets shredded, soldered, and scattered into landfills. Once it's inside a smartphone or a solar panel, it's rarely economical to recover. That distinction didn't matter much when demand was modest, but it matters a lot now. Fast forward to the early 2000s. China joins the World Trade Organization and begins the fastest industrial expansion in human history. Cities rise, factories multiply. Infrastructure explodes. The West celebrates cheap goods and low inflation, while China quietly secures commodity supply lines. Not just oil and copper, but strategic metals, silver included. At first, this barely registers. Global mining output seems adequate. Prices stay tame. Western investors lose interest. Then the energy transition accelerates. Solar power, electric vehicles, grid upgrades, and battery technologies all have one thing in common. They need silver. Not as a luxury input, but as a critical conductor. Solar panels in particular are silver-hungry. Each panel uses only a small amount, but when you scale that across millions of installations, the math becomes brutal. By the early 2020s, solar alone is consuming more than 15% of global silver supply, and that percentage keeps rising. Here's where cause and effect kicks in. Governments in the United States and Canada roll out aggressive climate policies. Subsidies, tax credits, renewable mandates. At the same time, China doubles down on solar manufacturing dominance. Beijing doesn't just want clean energy. It wants control over the supply chain. Panels, inverters, grids, exports. Silver becomes a bottleneck. At first, the market tries to ignore it. Analysts say efficiency gains will reduce silver usage per panel. Recycling will fill the gap. New mines will come online. But mining doesn't respond to demand overnight. It takes a decade or more to permit, finance, and build a new silver mine. And recycling only works when prices are already high enough to justify recovery. For years, silver prices stayed too low to incentivize either. This leads us to the breaking point. By the mid-2020s, global silver inventories begin to show stress. Exchange-tracked stockpiles decline year after year. The London Bullion Market Association reports shrinking above-ground supplies. COMEX-registered inventories trend downward. These aren't conspiracy numbers, they're publicly reported. But they don't make front-page news because they don't fit the narrative of abundance. At the same time, China makes a subtle but powerful move. It increases silver imports while quietly restricting exports of certain refined metals and processing technologies. Official statements frame this as industrial policy, but the effect is unmistakable. More silver flows east, less flows back out. Domestic Chinese demand absorbs supply that used to balance Western markets. Prices begin to stir. $25, $30, then sudden spikes that analysts dismiss as speculative froth. But here's the twist. This rally isn't being driven by retail investors. It's being driven by physical demand. Fabricators are locking in supply, governments are stockpiling, and yes, China is at the center of it. The real shock comes when Chinese buying coincides with declining mine output in key regions. Environmental regulations tighten, labor costs rise, ore grades fall, silver production plateaus just as demand accelerates. This is classic scarcity economics. Too many claims chasing too few ounces. By the time Western media starts paying attention, prices are already sprinting. Futures markets scramble to adjust. Industrial users hedge aggressively. And suddenly, $63 an ounce no longer sounds crazy. It sounds conservative. Now zoom out and look at the fallout through a North American lens. In the United States, inflation may have cooled from its 2022 peak, but the structural pressures haven't disappeared. Federal debt continues to climb, pushing past $35 trillion. Interest costs rival defense spending. The Federal Reserve talks tough, but political pressure builds with every debt ceiling standoff. In Canada, household debt remains among the highest in the G7, with Toronto and Vancouver housing prices still stretched relative to incomes. Both systems depend on stable supply chains and predictable input costs. Silver scarcity disrupts that stability. Solar projects become more expensive. EV rollout timelines slip. Grid upgrades cost more than forecast. Governments respond the only way they know how. Subsidies increase, deficits widen, central banks stay accommodative longer than planned. The feedback loop tightens. This is where failed fixes come in. Policymakers assume price signals alone will solve the problem. They won't. Higher prices don't create silver overnight. Recycling takes time. New mines take years. And substituting silver in high-efficiency electronics isn't trivial. Physics doesn't care about policy deadlines. Meanwhile, financial markets do what they always do. They extrapolate, momentum traders pile in. Headlines scream about silver mania, and the real story gets lost again. This isn't about speculation. It's about a metal that sits at the intersection of money, energy, and geopolitics. China understands that intersection. It always has. That's why its move matters. Not because it manipulated markets, but because it acted in its own long-term interest while others assumed the old system would hold. And now we arrive at the present moment. Silver prices are racing, not because the world is ending, but because the math finally caught up. Demand rose steadily, supply stagnated, inventories thinned. One major player secured its needs early, the rest are scrambling. So what does this mean for you watching from the United States or Canada? It means the energy transition will be more inflationary than advertised. It means supply chains are more fragile than headlines suggest. And it means silver's role as both an industrial necessity and a monetary hedge is re-emerging at the worst possible time for debt-heavy systems. Before we wrap up, let's make this concrete with 3 clear takeaways. Number 1, silver is not just a precious metal. It's a strategic resource. When industrial demand collides with monetary demand, availability matters more than price. Number 2, China's actions didn't create scarcity. They exposed it. Long-term planning beats short-term market assumptions every time. Number 3, the United States and Canada are entering a decade where energy policy, debt policy, and commodity markets will collide. Silver sits right at that fault line. And here's the question I want you to sit with. If silver really does become unobtainable at scale, not unavailable for investors but unavailable for industry, what else in our modern economy breaks quietly before anyone admits there's a problem? If this is the kind of hidden financial history and forward-looking analysis you value, you're in the right place. This is Cash Historian. Like the video, subscribe to the channel, share it with someone who still thinks commodities don't matter, and drop a comment below with your take on where silver goes next.